Good morning, everybody. Welcome to Jobs Thursday. That doesn't roll off the tongue well.
Isn't it
Jose,
usually Jobs Friday?
it is. So what's going on, Jose? Why are we
Well,
here on a Thursday?
we have a 3-day weekend. Markets are closed tomorrow, July 3rd, due to the Independence Day holiday, which falls on Saturday. So because we have that 3-day weekend, Bureau of Labor Statistics decided that it's going to be Jobs Thursday and not Jobs Friday. And we're very pleased that the audience is joining us today on Jobs Thursday.
Well, I wonder, does the Bureau of Labor Statistics know something that we don't know? Is it going to be a bumper report to make everybody feel good about themselves on the 250th anniversary of the nation?
Well, I will tell you one thing. If we get a 250,000 payroll number, then rates will shoot up to the moon, and everyone will expect Kevin Warsh to want to hike 3 or 4 times this year. Just kidding. Probably 2 to 3. The next move from the Fed is expected to be a hike, not a cut. As we started off this year, we had inflation at 2.4% on CPI. There was an expectation that we could get 2 to 3 cuts. But of course, the US-Iran war really turned that case upside down. And now we're looking at a few hikes with this new Fed chair, who yesterday in Central Portugal European Central Bank Forum said that he's pleased with the inflationary pressures receding. However, he still thinks that they're too elevated. So a little bit of a neutral comment there. Happy that the war is over, happy that oil prices are down, risks are lower for a broadening of inflationary pressures. However, still signaling that he has work to do on the inflation side of the mandate, especially against the backdrop of a labor market that's been really on fire. Job openings this week, 24-month high. Who would have thought? ADP payrolls, very strong. Few months, not just one number. Challenger, Reagan Christmas, very good for June. We thought this year that artificial intelligence adoption, elevated interest rates, and immigration restriction would really hamper hiring momentum. But this economy has been so robust. Consumption's been there. Business investment for AI has been there. Capital markets thriving, especially the Russell 2000 up north of 20% year to date. And really all those factors have been really comprising this, making up this buoyant landscape that we have.
So Jose, that's a really nice wrap. First of all, I should invite the audience to input any questions on X, LinkedIn, so on, to direct them to Interactive Brokers if you want to ask a question of Jose. You mentioned 250,000 would be a comical number, but is it really out the realms of possibility?
Well, let's take a look here at our forecast trader. We see that a number above 200,000 carries just a 4% probability. I'm getting old. Let me put on my glasses, folks.
And I think the Economist forecast for today's number for June jobs is 110,000. Yet but that would be coming off a 3-month average of about 188,000. So the economy's been generating a decent number of jobs.
Yes, definitely a decent number of jobs and acceleration that really none of us thought was possible given the headwinds that we mentioned earlier, especially with the immigration restriction that hampers labor supply, and then with the rates and the AI, we're thinking that labor demand would be subdued, but not the case at all. We'll open up a chart of payroll employment, but real quick, I'm going to show you just what the odds are for this number, and really the 50-50 level is at 111, 54% chance higher. So here, participants in the Interactive Brokers marketplace thinking that we're going to get a beat. Also in the Kalshi marketplace, sorry, that was forecast X at 111.7. Yes, at 54. on Kalshi, which is also, for those of you that don't know, ladies and gentlemen, we are now offering Kalshi contracts within the Interactive Brokers Prediction Markets universe. The above at 125,000 is at 53%. So a little, folks on Kalshi, a little more bullish. Spreads a little wider here as well. So you'll notice that the spreads here, 53 and 54, wider than 54 and 47 on Forecast X.
So if I was bullish here and I wanted to take that 150,000 above 150,000, that's only costing me roughly 34 cents. So 30, that would mean now I'm paying $34 to potentially make 100 if we got a print bigger than 150.
Yes, yeah, that would be specific. Exactly on 125, on 150. Yes, 33. Yes.
Yeah. What takes your fancy here then? You wrote a piece yesterday suggesting some appealing contracts. What do you favor on that board there?
Really, I like the low ones here, the above zero. This was cheaper, going for 94 earlier. Now it's going for 96. But essentially, I don't think there's any path to a negative number here.
Therefore, 96 is worth $1.
Yes, assuming that we get something above zero.
Right.
Those are my favorite contracts here. I really didn't have. I actually found some value in the initial claims data point, which is also coming out today. That's a weekly number. That's really where I found the value. Here, I didn't. This is a volatile indicator, and I didn't really. Nothing really. Sometimes in the articles, I'll offer an undervalued opinion, but here, there wasn't anything that stood out too much outside of that above zero contracts. In recent days, however, there were some great opportunities. For example, on JOLTS, I noted a 38-cent yes at 7.2 million. I thought that was way too cheap. That ended up paying $1. That was on Monday. So there are some occasions where we'll find some undervalued contracts. In fact, let's just go here to Traders Insight, to the forecast trader section, just to see sort of what the recommendations have been lately. So here in the Euro CPI, I recommended a 2.6 yes and a 3.4 no. That was a combination trade. I figured that was going to work out just because there was really no path for 3.4 or for 2.6. So I thought that was pretty much an easy one. I recommended that in this piece. This is the home run here for this week, folks. A 38-cent yes at 7.2 million. Essentially, it required a sharp decline from 7.618 million. Everyone thought we would get a pretty meaningful drop. We actually didn't get a drop. We got an increased, albeit the previous month got downwardly revised. So this one was really a home run. This one too, folks, the 650,000 no on new home sales for 38 cents. Also a home run that ended up paying $1. So folks, we're talking about 38 cents becoming $1, $380 becoming $1,000, $38,000 becoming $100,000. Just so you guys understand the math. Yeah, those were the recent home runs that we hit. Well, another thing we're doing is we're adding the price inside of all the titles for relevant contracts. So that's something that you can watch out for, folks.
Very good. You're making this sound easier than making predictions on the World Cup.
Yeah, I mean, it's sometime, this one could have been a home run here too, Andrew. But this one didn't work out. This was a 4-cent contract at 3.75 on U.S. gasoline. That one didn't work out because the retail prices didn't drop as fast as I would like. But I thought 4 cents was too cheap.
That's based on is that the AAA price of gas?
Yes.
Right. And what was the outcome? Out of curiosity.
381.
381, but it was still lower than I think the market was expecting, right?
Slightly. My rationale here was that essentially you had a 90. You had the last time that the gas price came in at 372. West Texas Intermediate was in the 90s.
That's right.
And it was in the 60s as when I wrote this last week. It's still in the 60s. So I figured, you know, the 375, no, was too cheap to ignore at 4 cents, albeit those moves on the commodity down into the retail price, you know, they do work with a lag. You know, West Texas, a drop there doesn't immediately show up on the retail prices. It's more gradual. Turning to the main event, let's not talk about. We are 3.5 minutes away. Let's focus on what we're looking for here. 110,000 non-farm payrolls, 4.3% unemployment rate. That would be unchanged. Initial claims 220,000. Continuing jobless claims 1.810,000. Job growth would be down from 172. It's going to pull up a chart here.
And we'll be looking out for revisions to this as well. but what we've got used to, just like in the bigger picture, is actually stronger than expected data in the more recent months. Jose, in terms of as you load that chart, where are you expecting to see the bulk of job growth come from, in which sector and so on?
Education and healthcare. That's really been the dominant one. We saw that also in ADP. We've had some buoyancy, folks. I mean, the last 3 months of hiring, May, April, and March, exceeded every month over the past 12. Look at this, folks. This is quite an acceleration, albeit some give back from February. But, you know, last year in 2025, job growth was not even close to how buoyant it is now. Just pointing to initial claims, I forgot to mention, I thought the 76-cent yes at 210,000 was attractive because last 7 prints have been 210 or above, and summer does tend to sport some volatility. On top of it, 37 forecasters in a weekly Reuters poll ranging from 215,000 to 230,000. So no one thinks that 210 is in the cards, really, in layman terms. So I thought the 76-cent yes there was attractive. Back to job growth, very buoyant last 3 months, very strong. And we have a minute and a half right now. Interest rates are a little higher at the long end, the 10-year above 450. So we got to watch that because that's a pivotal area of support, resistance rather. And then the 2 years right around 418. So, you know, 2 year not far from its high of the year, around 424, about 5 basis points away. 10-year, however, quite off the 470 high of the year. Oil, folks, look at oil, unbelievable. $67. This is the lowest going back to February. So pre-war levels here on oil. Really just unbelievable development. Really just got almost cut in half from its high of 120 on early March down here in
and then
down to 67.
The equity markets, last time I checked 15 minutes ago, there was very little change going into the session. Is that right?
A little more of a wake up here, a little more, about 17 points higher on the S&P, hugging 7,500 here. Another pivotal number here, 7,500. Pivotal midpoint here, 17 seconds away, 250th birthday of the U.S. Volatility levels subdued, 16 VIX. Dollar's been getting stronger lately, but today paring some of that back, and we're almost there with the number, folks.
Okay, let's have a look. Let's try and use the internet to search for the numbers. Let's get this going.
Equities higher. Rates a little lower.
Oh, I'm bang in line at 112,000 by the looks of it. Or am I looking at the June report? May.
57,000.
Through 100, I'm seeing 100. Oh, just looking at the wrong page. $57,000, way below, but still above zero. Unemployment rate 4.2.
Yeah, we got a little bit of a mixed report here.
Yeah.
Mixed report here. Poor sector breadth in terms of gains. A lot of things near zero. Unemployment rate did tick down to 4.2. We'll check out why that was. Across sectors, it was private education, health services, the leader, 69,000. Professional business services up 36,000. Nobody else gaining notably. Construction 11,000. Everything else 8,000 or below. Other services, government. Got some losers here, mainly leisure and hospitality. This is pretty alarming. This was also weak in yesterday's ADP report. This is tourism sector could signal something about discretionary spending.
Well, I find that an entirely unusual loss of 61,000 jobs for June, right in the middle of the World Cup. Jose, that doesn't seem right.
Yeah, no, these numbers have been all over the place. It's been one of those volatile indicators, especially with the revisions. But yeah, not a great development. Information and finance; those are the two areas most vulnerable to AI. Those were particularly not as weak, but still sluggish. Information down 9,000. Financial activities flat, negligible. So pretty weak report here, I would say. Rates. Sorry, go ahead.
I was going to say, and I was crowing about a 188,000 3-month average. That slipped with today's report and revisions to 111,000. The 3-month average.
Yeah, still strong. On a 3-month average basis, 59,000 doesn't weigh on you that much, but still in effect. Labor force participation flat at 61.8. Let's see what happened with the labor force. Oh, never mind. These aren't updated yet. We'll look at those later. We're going to go to Steve Sosnick now for our video on IBKR Prediction Markets, and we'll be right back.
What exactly are prediction markets?
Prediction markets are a way for ordinary investors to express their views on market-related events, some of which have very important consequences for one's investing. For example, we all know that elections have ramifications for markets. With midterm elections approaching, it will be very easy for investors to decide who they think has the better chance of taking the lead in the House of Representatives, the Senate, or in any range of specific congressional or gubernatorial elections. Prediction markets make that very simple. You can speculate on these races, or you can effectively use them as a hedge on your investment positions, but doing so in a much more targeted way than one was able to do before the advent of these products. This, to me, is the beauty of prediction markets. You can express a view on something that is market related or investment related, but that has always been historically difficult to factor into prices in a direct manner.
Walk us through the mechanics. How does one trade?
In terms of the mechanics, it's really not that difficult. You buy the yes if you think that the outcome of the contract will occur. You buy the no if you think it won't. And you also exit your contract by buying the opposite contract. So if you're long a yes, you buy a no. If you're long a no, you buy a yes.
Then how does one calculate profit and loss?
Prediction markets are quite straightforward. They trade at a value between 0 and 1. And these are dollar contracts, so you can speculate a little more in terms of the number of contracts because dollar value is low. And in terms of their percentage return, that's based on what you paid and the difference. So the leverage can be quite powerful because if I pay 40 cents for a given contract and it resolves at 1, I made 60 cents on my 40-cent investment. That's 150% return.
And what are some risk considerations?
One thing that we believe mitigates the risk is that these are financial contracts, not bets. These are financial contracts by a reputable financial firm with important financial regulation behind them. We believe that these prediction markets are a valuable tool for investors to speculate on or hedge risks that otherwise have not been easy to incorporate in one's portfolio. And that's why we feel very strongly about these products as investment tools and risk management tools rather than just purely speculative instruments.
All right, we are back.
Did you see the initial claims data yet?
Yes, 215,000. So that yes at 210 would have worked out.
Paid off. Nice. Okay. I just had a look at the employment situation summary. A net downward revision for both April and May, totaling 74,000, and with today's weaker number, that's why we've come down from a 3-month average of 188,000 jobs per month to just 111. And then the comment from the government or from the BLS on leisure, which fell 61,000, was weaker than usual seasonal hiring. And that's just kind of going off in my brain with the World Cup going on. I don't get that one at all.
Yeah, let's pull up. Let's see how leisure has been doing in recent
You can't
months.
have a once in 4 years event that would be adding jobs here in the United States across those multiple different cities, and it not show up in the data. I don't know what the competing event would have been last year to make this seasonally weaker.
Yeah, no, and not just that, but a big revision to last month too in May. May was up at 70,000. Now that's down to 40. Down to 61. So really been weak over the last 3 months. -7, +40, -61. So we'll have to definitely do some more investigation and see what's happening here in leisure and hospitality. Andrew, could also be a supply story. Could also be, this is a big sector where you have folks from a lot of foreign workers that the immigration restriction could be weighing on that sector. We'll have to wait and see what's going on. But another interesting thing was the labor force contracted by pretty notably actually down to 720,000. So this is people that either said, I give up looking for work for whatever reason. They're not working and they're not looking for work. So 720,000. So we'll see, over time, what's happening here. Also, you see people not in the labor force that has risen from last June, 103 million people up to almost 106 million people. So on a year-over-year basis, we have roughly 2.6 million people less in the labor force participating in employment. That could be retirement, that could be taking care of older family members, that could be sickness, that could be getting discouraged, et cetera, and et cetera. Let's look at some wage pressures. Wage pressures were accelerated here on a year-over-year basis as expected from 3.4 to 3.5. Still trailing inflation. We'll see what inflation comes in at. We don't get inflation data next week, but we get it the following. Probably going to be at 3.7, 3.8. So wages still trailing inflation. I don't anticipate that that's going to continue for too long. I think once inflation starts to go back into the low threes, wages could stay here in the high threes, mid threes rather, and then we can have, still have real wage buoyancy on a month-over-month basis, pretty strong and standard at 0.3%, which annualizes roughly to 3.6.
And I think on the average hourly earnings number, I think it was up by like 13 cents, $34.67, something like that. But it's not a big increase. But as you're pointing it out, it's I would say it's low. There's nothing saying that wages are ever getting out of control here.
Yeah, it looks like
up 12 cents. There it is. Yeah.
Yeah.
Impact on the equity markets. I thought I saw a little bit of red on the screen there as a result. No.
We're doing well. Yesterday we closed on at 74.83. This is the SPX 500 that tracks the futures and pretty much tells us where we would open at if we were to open at right now. So we would open at 75.15.
Gotcha.
Yesterday we closed at 74.83. So about 43 points or so, 40 points of gains, 0.5% roughly.
How do you interpret that, Jose? The response in the equity market to today's report?
I think it's really driven by this huge bull steepening we're seeing here in the yield curve. 2-year down 6 basis points, 10-year down only 1, pointing to subdued expectations for Fed hikes on balance. Let's go look at the Fed Watch tool, see where we are on hike.
Having said that, the interest rate market has moved from anticipating interest rate cuts to interest rate hikes. So I think it's getting a little stretched to the upside in the event that there's nothing here says that we need more interest rate hikes than is already baked in. Is that a fair assessment?
Correct. Yeah, correct. In fact, it's pointing to the fact that labor market conditions are slightly weaker on balance than when we thought 20 minutes ago. And for that reason, the probabilities of a hike are less. And 25 basis point hike by end of the month down to 17%. By September, up to 45%. 2 hikes by then, 45 plus 7, 52%. Sorry, 7%. Well, this means rather 52% chance that we get at least 1 hike by September, folks. 52% that we get at least 1, 7% that we get 2. This is a serious Fed here, really changing, what the expectations were from the beginning of the year. 3 hikes by October, 1.4%. 2 hikes, 14.5. 1 hike, around 60%.
Right.
December. Sorry, one more time here, folks. Just by year end, this will be the last one we do. We don't want to talk too much about hikes, huh? 0.5% chance that we get 4 hikes by year end. 7% chance that we get 3. 34% chance that we get 2. And 76% chance that we get 1 hike by year end. So, clearly here the market is bracing for hikes, albeit a lot less than it was pre-number. 10-year down 7 basis points now, 10-year only 2. So really getting a steeper curve here. We were getting a flatter curve. We had the flattest curve in roughly 16 months where we were even at getting close to a risk of an inversion. We're at like the 20 basis point mark between 2s and 10s. Really the market signaling, hey, Fed Chair Warsh, we can't handle this many hikes. We can handle 1, we can handle 2, but once you start pricing 3 or 4, we're going to invert the curve because we're going to start paring down growth expectations over the long run.
As a result of retardation of growth. All right. So I'm sorry, I know it's America's birthday coming up, but I felt all kind of bullish and excited before the jobs report. And now I'm feeling a little bit, let's put a dampener on things a little bit, Jose.
I don't know. I think you should be a little positive. Look at the market. Look at the market. I was looking for a modest miss yesterday. I said a modest miss around 95,000 would be good for the market. Here we get a little bit more of a notable miss, a meaningful miss. Yeah, and to get these insights, folks, you can get it in your email or you can just go to Traders Insight. I'll write an article a day. And really here, this is the July 1st article. Here in the conclusion, Independence Day rally following BLS jobs. I was expecting a figure approaching 100,000, 95,000. That result is poised to offer a terrific end of week for investors. And the good news is that participants won't have to digest any pivotal economic figures until the week of July 13th, when inflation data is out. Numbers that are strong, but not too hot, would point to an ongoing expansion in the labor market without raising yields, factors that would be conducive for another session of fresh records for the Dow Jones Industrial Average and the Russell 2000. I think that's what we're going to get. We didn't get to 95,000, but we got there in around 60,000. So a miss, but still labor market still progressing, still a little worried in some of the sectors, but that's okay. Still progressing, overcoming the big drop in leisure and hospitality. Without that big drop, if leisure and hospitality would have been 0, the number is 120. So that's that's a meaningful number as well. Here we have an interesting pattern. Of course, we had this high at 76.20 back in early June, and then we came back down close to 72. But now we made a higher low, and now it looks like we could be here potentially. Let me see if I know how to do this as well as Andrew, our Director of Trading Education. Here, a higher low here. What do you think about this here, Andrew?
It seems to be coiling higher, doesn't it? I mean, you from that June top to the low, which only took about, I don't know, a week or something like that. You break that top and you've got some distance to the upside if that happens. So it looks pretty good to me, but what do I know? It's not too late to submit any questions. Direct them to us on LinkedIn and X on the live stream channel here. What was I going to ask you, Jose? I was going to ask you about. I've kind of given up expecting manufacturing jobs to make a comeback. It's just not happening. What are your thoughts on that? What are your thoughts vis-a-vis President Trump's $1.5 billion in crypto income since he took office? Which one's more important? Manufacturing jobs or making crypto bets?
Well, manufacturing is job openings is following the trend. It's up to 529,000 job openings in manufacturing. So maybe a lot of folks aren't showing up for the factory jobs. Maybe a lot of those where those occupations are located, a lot of folks aren't geared or positioned to want to accept those employment offers. I think also that a lot of those factories need to get built before employment boosts. But it's been it's been quite weak, the story in manufacturing.
That would be a very interesting deep dive into the openings there, Jose. I was not aware of all of those job openings. It would be interesting to learn geographically where and in which companies and what the jobs were paying.
Yeah. We'll dive into that stuff. For now, we have to go though, unless you have a little final insight to give us.
I'd just like to say happy birthday to the nation. It's 250 years tomorrow. On Saturday, since the nation was born, and it's I'll be out there celebrating with the rest of the United States. What are your plans, Jose?
Absolutely. We're blessed to be here. My family my father's side came from Cuba, where we definitely didn't have the freedoms that we have here, the human rights advances, the free markets, the freedom of speech. And I think, we're blessed to be here, blessed for the economic opportunity that we have, our capital markets, our labor markets. We're really going to be thankful this weekend, Andrew, for the opportunity to be here in the U.S.
Very good. Okay, do you have a one more moment, Jose? What's your favorite prediction market coming up?
My favorite prediction market coming up. That is a really, really good question. Let me put on my glasses and let me see. I didn't really have anything in mind. Usually it's a CPI, but because that's coming out a week from now, let's take a look at the landscape.
I think you should do another. You did a really good podcast. I think it was called Wall Street South. I think it's about time that you got together with your friends down in Palm Beach County there, and had another roundtable to go over a few of these items.
Yeah, I think so. Yeah, I've been looking at the House race. That's been really handily in hands of the Democrats. Also, the House race. Here, our elections dashboard.
Very nice.
Gonna look here for our House. Sorry, Senate. Yeah, this is going to be an important one, folks. Because if the Republicans are already expected to lose the House, but if they also lose the Senate, then that'll kind of handicap President Trump's ability to pass much legislation for the final 2 years of his second term. So this is an interesting one to look at. And then, of course, who the candidates are going to be for 2028. I think that's also pretty interesting. For example, here on the Democrat side, we have Gavin Newsom leading of California, followed by Alexandria Ocasio-Cortez of New York, Pete Buttigieg, John Ossoff, Kamala Harris, Josh Shapiro, and Andy Beshear leading on the Democrat side. And then at the GOP level, we have Vice President J.D. Vance at 43%, Secretary of State Marco Rubio at 37%, and current president, 45 and 47, Donald J. Trump at 7% for the 2028 presidential election. Andrew Wilkinson, that's an interesting contract.
It's an interesting one, and he's not somebody I'd want to bet against, to be honest. All right. Excellent transmission. Just give us the headline numbers again, Jose, before we wrap up.
Absolutely. Jobs, 57,000, below the 110,000 median estimate, below the 129,000, which was downwardly revised. Private sector employment, 49,000, below the 110 expected, below the downwardly revised 97,000. Initial jobless claims, 215,000, below the 220,000 median estimate, also below the 216,000 from the prior period. Continuing jobless claims, pretty unchanged, 1.814 million, a little above the median estimate of 1.81 million, and slightly higher than the previous week's 1.812 million. Average hourly earnings, 0.3%, in line with estimates, same as last month. Annualized, 3.5%, in line, above the 3.4. Euro unemployment rate stayed at 6.2, below the median estimate of 6.3. And that's what we have today for data, and we have a rally in the market.
Very good. Okay. Thank you, Jose Torres, Senior Economist down in Florida. And thank you to all the audience for joining us. And we'll see. When are you on next, Jose? Have you got the Spanish CPI next week?
We have the English CPI, not the British one, the English-speaking domestic CPI on the 14th with you. And then on the 15th, we have the PPI. We'll be covering that in Spanish with Judith Casasampere.
Excellent. Look forward to it, and always a pleasure. And we'll speak to you later on, Jose. Bye for now, everybody.
Absolutely. Thanks, everybody. Bear with me. I'm not seeing the end stream section.